Welcome to the Bitcoin Macro War Room, where we jack into the market mainframe and derug the narrative. Plug into the pipes, M2, DXY, inflation, momentum, fresh prints, CPI, ISM, payrolls, rates, truth by facts, not vibes. Tweets and news rundown, meme to policy, curated, timestamped, tradable.
Welcome, you've got mail.
Copium not included. Roll the tape, let's invest like it's 1999, but with better charts.
Welcome back. Happy Friday. It's officially December. It's my favorite day of the week. We're going to dive into another Bitcoin macro war room. And the theme of today's video is basically mixed signals.
Emotional, damn it.
We'll go over the system and what it's saying. We're going to take a look at a bunch of spicy tweets. I have a few extra charts on deck for you today, as always. And I have a little sneak peek into the tactical macro regime overlay that I've been working on. So let's dive into it because we have a lot of data to go over. And we're going to start off with our main chart. And the only real thing here to note is that we're still under the trend channel for the regime indicator here on the bottom. We are technically in expansion. A lot of these are green, but we're still struggling. The ISM print, which we'll take a look at in just a second this week, was not good and was not supportive of the whole ISM cycle narrative. And it's something I'm actually rethinking now in terms of my fundamental thesis, where we might have a truncated or shortened ISM cycle potentially because of the K-shaped economy here in the United States. Global liquidity in terms of M2 specifically is still positive and sort of trending up, but you can see that it's been still stuck in this range here for quite a while. Cool, with that chart out of the way, we'll take a look at the short term really quick. And again, we are having a bit of a down Friday here, and I did mention last week in the video that you really want to see these green bands be supported. Clearly, we got to a certain point here where we just basically dumped right through them, flipped the bands red, came back up, and we're basically doing a mean reversion type of market right now. I think the one plus here is that technically we are making higher lows. Now, will this be a higher low? I don't know, but we'll see as the price action kind of plays out. So with the short-term stuff out of the way, let's look at some of the charts I did want to share. Now, this one is basically a recreation of the momentum trend signal via the institutional research that I share during the portfolio / system portion of the video. And this is almost one-to-one of what they're doing. So you can see clearly we are still bearish, and we've been bearish since 112K based on this volatility adjusted sort of momentum signal. So still no real signs of recovery just yet. And if we take a look at one of my inputs to my tactical regime overlay that I've been working on, it's still red as well. And it has not had any positive performance. Basically, anything here in yellow or red means the trend is bearish or chop. And I would be cutting my position in yellow anyway. So regardless, the trend is still very clearly bearish. And until that starts to flip or show positives, or at least get out of the red and start printing yellows here, that's when I would maybe get a little bit more excited. But until then, I'm staying very, very patient. In terms of Bitcoin, stocks are another story, and we'll talk about that. But I did want to share what I've been working on. And I wrote a long Substack post about it. It's on my X if you want to read it, of basically how I kind of put this together and what you're really looking at here. And I'll zoom out so you can see how it's kind of worked in the past. Is this indicator here in the middle is the strongest one. It's the one that I've back tested that actually performs and slightly in certain sections beats buy and hold. Boring. With a maximum drawdown of 12%. And that is my goal. It's to limit drawdowns, but still be able to capture all the upside. So this has performed really, really well in the back test. You can see if I zoom out all the way to the year 2008, the back test actually goes to the year 2000. So I was super, super happy with this. It came out working really, really positively. The one on the bottom that I'm working on now is a refined version of this one on the top with more inputs. And you can see some of the inputs here in the Pine script in terms of the growth section. But this is going to be a constant, ongoing, living project because not only do I have to tune each indicator one by one. So you can see here, for example, I've been tuning the NASDAQ to sort of capture these bullish and bearish momentum trends. I have to tune each input, and there is a ton of them. There's like almost 30, 35 inputs for this.
Bruh.
All of them add to a different set of scores. So different buckets you can see here, Goldilocks, reflation, inflation, and deflation. You sum the scores. Whichever one is leading is the one that is the active regime currently. There's a bunch of other stuff around the actual logic that I don't want to get into, but this is what I've been working on. And so currently you can see the one I trust the most is still risk off. The refined, tweaked one is risk on currently. We're in Goldilocks. So again, mixed signals there, but I still trust the top one anyway. And we'll take a look at the institutional research because that is signaling still risk on. Cool. And I'll keep the chart updated sort of as I go and the progress I make on it and all that stuff. But for the time being, let's move on to the data because there was a lot of it this week. And the main one for me that I said was the most important was the ISM manufacturing PMI. And it came in at 48.2 versus a 49 forecast.
Come on, man.
Not good. Not what you want to see. I mean, we've been in this sub 50 zone besides these two prints in February and March and this one print in April 2024 since November 2022. We cannot get a sustained uptrend breakout of the ISM. Now, whether that's due to, like I said, the K-shaped economy or tariffs or whatever narrative you want to put on it, the takeaway here is the same. It's not good for the Bitcoin cycle because historically, even though over 4 cycles is a short time frame, it's been linked. So we really would rather see some positive prints there, but that is the number. That is the data for this month. So we'll see what happens in January. But at this point, it's tough to put this thesis behind what I'm doing, which is why I'm being also extra cautious. For prices, they were down a little bit, which is good. In terms of any of the other data, I don't think anything here was too massive. The ADP non-farm employments had a negative 32K print, so more fuel for the Fed to cut. ISM services did beat, but not by much. The expected was 52. And again, this has been kind of floundering in this 50 to 52 range for quite a while. Unemployment claims came in below, which is good, not good for the Fed, but it doesn't really change much. So that's the data for this week. I think in terms of next week, the most important data drops are going to be the JOLTS job openings. Obviously, we have the FOMC decision next week with a target of 3.75. So a 25 basis point cut is pretty much priced in. And that's kind of it in terms of the data for next week. All eyes are on the Fed. These numbers have not changed since last week. I think last week it was something like 82 or 85%. So we're at 87, which is fine. And then for January, there's only a 25% chance of them cutting another time. If we go out to March, there's only an 8% chance that they continue cutting into March. So could this be the last cut that we'll get? That'll remain to be seen. We'll keep an eye on it, but that's out of the way and let's keep it moving. In terms of liquidity and sort of my notes that I had. So I am a subscriber to Michael Howell's Capital Wars, amazing research, very finance heavy. You need to sit there and actually try to understand what you're reading.
Oh, hell no.
But this was something I wanted to share because this is my comment. And Mr. Howell, who is the godfather of liquidity, so to speak, completely agrees with my sentiment. And I'll read this really quick. A lot of the bullish catalysts, are still fairly far away. TGA drawdown will be a drop in the bucket. I just made an X post about this morning, and we'll take a look at the TGA next. The ESLR changes won't happen until next year, and balance sheet expansion in the United States will be moderate at best. I have a tweet about that at the end of the video too. So expect more volatility, and that continues to be my base case. SOFR EFFR spiked back up into the danger zone this week. Plumbing is still strained. And when I say plumbing, I mean liquidity plumbing. And I will pull up my stress dashboard, really quick so you can see it. But we did have another spike of the SOFR spread. Now we've come down today, which is a good sign, but that's generally the theme. You spike, you come down, you spike, you come down. You really want to see this stabilize under the danger zone and not have these sort of spikes. In terms of everything else, the MOVE index is really low, which is really good. That's for bond volatility. The DXY has sort of rolled over off its peak a little bit, and the VIX is still around 15, 16. So the rest of the stress dashboard is good. This is what is causing my main concern, which is the SOFR effective fund rate spread. So while I am positive in the long term, I think there's still a battle to be had in terms of the Fed injecting some sort of stability, especially for overnights and money markets and basically the repo system. If we look at the TGA really quick, you can see from last week where we were down to 903 billion, and I said we might see potentially another 25, 50 billion rolled out. Well, this week's print went back up to 937. So the TGA drawdown, if you ask me, technically has not started yet. Now, are we net smaller since the peak? Yes, but by what measure? By 15 billion. So people waiting for this TGA to be drawn down aggressively, I think, are going to have a bad time. Regardless, TGA stuff is out. Let's look at the actual system and what that's saying. And lo and behold, we are risk on based on the institutional research. We are back to risk on. Now, with a caveat, and again, this is not financial advice, but a caveat is that for Bitcoin, the momentum and the trend is still bearish, which is why I'm not invested currently, and I have not begun building positions. Earlier this week, I have begun building very small positions in the S&P 500. So my portfolio currently, how it's going to be structured, I'm going to share this for all to see and for all to laugh at. So let's take a look at what I'm actually going to be doing now that we're back risk on. So this is a very simple high-level view of my portfolio, what I want it to be. The current crypto allocation, and by crypto, I mean IBIT, which means Bitcoin, is 0 because the trend is still bearish. Once the trend flips bullish, I will begin to DCA. For SPY, I have like 2.25% in, and I'll explain why I haven't been aggressively DCAing. I'm basically doing a 10% weekly DCA because of some of the issues that I'm seeing, which I'll go over in the tweets portion in a second. But overall, the way to look at this portfolio is that I fixed some of the numbers, but overall, how to look at this portfolio is that currently I'm going to be 45% in SPY. This is assuming all the trend stuff is bullish. This would be my actual allocation. I would have 34% in Bitcoin, 45% in S&P, 10% in gold, and then a couple of percent in some call spreads, a bull put sleeve for SPY, because that is a great income generation strategy that I have when the trend is bullish, some call spreads for both SPY and IBIT, and then a tinge of gold, given just a bit of diversification and the debasement trade as a whole. I think it's important to have both some gold and some Bitcoin. Obviously, I'm heavily favoring Bitcoin in this outlook, and these might switch. So these allocations are not static. I might at some point decide that there's more bullish catalysts or more room to run for Bitcoin, and Bitcoin might get 50% while stocks get 30 or 25. So this is going to be moving. This is just the current target. And given that the S&P is bullish in terms of its momentum and trend, and gold is bullish in terms of its momentum and trend, those are the ones that I am allocating to. You can see for gold, I'm almost fully allocated. For S&P, I started a very small allocation this week, but there are some things that give me pause. My tactical regime matrix is still bearish, the one I trust so far. The tuned one that I'm working on is bullish. The institutional research is bullish, but there is a caveat. And I know I've shared this back a while ago, but basically this is a model that shows how close are we to potentially a top and a pretty significant correction coming, meaning 10% or more. Probably 3 or 4 weeks ago, I was harping on this chart, and at that time it had 6 red numbers. We are currently at 8 red numbers. God, please, and even back then I said, I've never seen it this high before. This would give me caution. And this is why I am not DCAing super heavily right now. And I'm just being cautious. The investment, the macro institutional research a couple of weeks ago went risk off, went very hastily back to risk on. To me, that signals that there's still issues. And for everything that I'm looking at in terms of liquidity, it still doesn't look ultra great until maybe mid-January towards February. So I'm giving it some pause. I'm not going balls to the wall. I'm trying to keep my own pants on. And this is the current strategy, which is very, very slow DCA. If Bitcoin does go bullish on the momentum and trend, I'll put out an update video, or I'll do a Substack post, I'll write a Twitter post, whatever. But regardless, that is the system. That is what is going on right now. And we did have a look at sort of my portfolio setup. If you're really interested, the portfolio setup I had while we were risk off is here. It's deflation, which is what we were in for a couple of days. And basically, there's no allocation to stocks. There's no allocation to crypto. The only allocation is to 25-year treasuries, 5 to 10-year treasuries, corporate bonds, and gold. And that's it. And that's basically my defensive portfolio if you're interested in it. But that's the system at this point. Nothing changing the numbers. I'm just still being extra cautious. Not in Bitcoin right now, in stocks very, very slowly, and just in a gold position defensively. So that's it. In terms of the on-chain data, I don't think there was too much to glean here. A lot of things are still bearish. Macro heat phase actually came up a little bit out of the green zone, which is nice to see. But again, we really need to see some sustained movement here back towards the midline for any kind of positivity. Sharp ratio is back sort of near the green zone. Adjusted Nupal is back in green, and everything else is sort of the same. I spoke about this last week, so I won't harp on it, but you really want to see long-term holders buying and not selling this aggressively. So this is pretty crazy in terms of the numbers for LTH versus STH. Other than that, not much to glean from the on-chain stuff. So let's take a look at the liquidation heat maps really quick. And I don't really care about the 24 hours. So let's load up let's start with the 2-week, take a look at that. And then we'll move on to the tweets afterwards. So 2-week liquidations, there definitely is still some upside up until 95-ish. But you can see there's a pocket down from 80 to 84. But let's take a look at the 3-month, which is the long term that I'm more interested in. And yeah, I mean, all the liquidations are basically to the upside, although not too many crazy areas. Obviously, given the price action recently, we've been stacked to the upside. If you go out to the 1 year, we're kind of in no man's land, right? Yes, there are liquidations up until 98, and then there's some liquidations below from 70 to 80. You have this huge cluster up here at the top at 126. Cool. I hope we get there. I hope so. And the systems will get us back in if that is going to happen. So regardless, this is what still gives me a ton of pause. 8 red numbers on this model is not good. I've never seen it before, just like I didn't see 6 or 7 before. And we did have this sort of, I would say, correction, at least in stocks, from the end of October to basically the end of November last month. We've rallied since then, but this still just gives me a lot of pause. It almost feels like there's something big waiting. We just don't know what it is yet. You ever have that feeling? It's weird, but That's what I feel right now. This was just something funny, just something lighthearted. I don't trade, obviously. At least I don't consider myself a trader. I consider myself an investor. If you're doing this or you feel this way, you really need to sit down and take a look at the systems you're using, the criteria, or just start actually doing this. Like when you think about going long, you know what? Just go short instead. Do that for a couple of weeks or a month and see how you do. That might make you feel better. Plus, I had to share this because of the Fight Club photo. So regardless, this is a stupid tweet. They got a lot of traction that I just wanted to call out. The secret to investing is to invest in unstoppable people building inevitable things. These kind of highbrow, brushstroke type metaphorical tweets, they sound really nice. They sound cool. It's kind of like the self-help type stuff, but this is just the most stupid garbage, low IQ that I've seen. And I know that sounds mean. While it is a nice tweet and I get the sentiment behind it, the secret to investing is not losing money. There you go. That's the secret to investing. The secret to investing is A, not losing money, and B, compounding the money you already have and minimizing drawdowns and getting into the positive trends. That would be the secret to investing. I would even say understanding the macro landscape is also the secret to investing. What are bonds doing? What are credit spreads doing? How does the VIX look? What does liquidity look like? How are small caps doing versus big caps? Are cyclicals outperforming or are defensives? Things like that. This kind of stuff, whatever. It looks good for a tweet though, so shout out to him. Milk Road Macro. This is one of the things I mentioned earlier. The Fed will be forced to start QE very soon. According to most analysts, it will start as early as Q1 26. And this is still a projection, right? Remember that. While they ended QT technically in December 1st, they haven't started any QE yet. And by the time they start, that still has to run through the system, like I've been saying. And here's why the QE will be very different. The pace of QE will be very slow. The balance sheet is expected to increase about 20 billion per month. That is chump change. That is nothing. And he says that it's tiny compared to the 800 billion per month in 2022. The type of QE will be different. It will be the Fed buying treasury bills, not treasury coupons. So treasury coupons equals real QE. Buying treasury bills equals slow QE. If I have my nomenclature here right, bills are basically front loaded, like they're short-term debt, and coupons are long-term debt. So the main takeaway is the overall direct effect on risk markets from this QE will be minimal. And I completely agree with this take. People are blowing this out of proportion. It is not going to be as good as they think. And you can see here the kind of slope that we have. It's basically like nothing. I mean, we've been higher in 2022. So I don't know. Liquidity picture still doesn't look great for me. Here's one from Hayek and Keynes. One of the most straightforward ways to show debasement is via the price of Campbell's tomato soup, rather than relying on a complex set of estimates and substitutions. It's just a historical record of what the same can of soup costs over time. And you can see it's a pretty insane graph. So we've had no inflation from 1895 to about 1975, and then things went kind of ridiculous. And I probably don't have to explain to you what happened in 1975 to 1985. You can go look that up yourself, but that is where we're at right now. So while I think inflation has slowed, it is still rate of change positive year over year. And that's what you have to remember. If the inflation rate is 3 or 4% every year, that's compounding. That's on top of whatever it was last year and the year before. It's going up. And the debasement trade is the only thing that really fixes it, because everything is going to be more expensive in dollar terms. Regardless, tomato soup is good. Go make some tomato soup this weekend. Key Young Jew here with most Bitcoin on-chain indicators are bearish. Without macro liquidity, we enter a bear cycle. And I totally agree with this. Keyword being without macro liquidity. The Fed will need to inject some sort of liquidity. However that bazooka looks, whatever it looks like, that'll be beneficial, but I don't see any signs of it yet. You can see the chart here. Pretty much all the signaling here in this chart is red. And you can see last time even most of them were red. We had pretty bad performance going forward. So bad overall, bad. Could this turn? Yes. Do I hope it turns? Yes. Has it turned? No. So we'll continue. Last one here. Every recession since 1960 has been preceded by a material downturn in the LEI-CEI ratio. And these are just basically economic indicators. Today's reading is squarely in that danger zone, one of the lowest readings in 60 plus years here from Lance Roberts. And this is kind of what I said in the beginning of the show. And you can see these gray highlighted areas are what are technically recessions. We've been in a recession for the lower half of the economy here in the United States for 3-4 years. And you can see that clearly here on this chart. They just haven't, quote unquote, named it a recession because Wall Street has been doing great, right? Asset prices are near all-time highs. But the low end, the bottom half of the economy and all the consumers have been beaten down by high interest rates, unable to get liquidity, short-term loans, higher prices. It's not good. We've been technically in a recession, in my opinion, for the last couple of years. So Fed really needs to get off its butt, do something. But that's it for this week. Again, some mixed signals this week. It's kind of hard to establish what is really going on under the surface. I know for one thing, overall, we're still risk on, but I'm being very, very cautious. If I had to pick one horse or another, it would be stocks right now. Currently, given the bullish trend momentum, Bitcoin is still bearish for me, and I'm sitting out until that changes. If and when that does change, I will post a video update. If you want to get the minute to minute, like this changed just now, follow me on X or Substack. That's where I do the sort of flash updates, things like that. But currently, it is what it is. The signals are what they are, and I'm going to stick to the systems. I hope this helped you out. If you made it with me this far, thank you so much for watching the video. If you did like the video, you know what to do. Not even going to ask you for it, but I hope you have a great weekend this weekend and enjoy December and the holidays. I will see you next week on Friday for the next War Room update. Cheers.